let's just maybe start with the whole estate tax formula at the top, identifying the fact that the gross estate oftentimes is much bigger than you're expecting it to be, because we've got all these things that we're going to be deducting. And that's, we'll fly through many of these, like last medical expenses, pretty self-explanatory. Administrative costs, lawyers and probate fees. Funeral expenses, that's pretty straightforward. Debts of the decedent, like if there's a mortgage in their name that we needed to pay off, for example, that's going to be a deduction against the estate. Losses during the administration of the estate, if they have a theft or some other, bad thing happen, that we get to deduct. But that gets us to the adjusted gross estate. And then we have all of these interesting deductions for charitable deductions that we make if the will left something to charity, marital deductions, whatever they transfer to their spouse, or state tax deductions if they had to pay a death tax in the state that they live in. We don't have one here in Wisconsin, so that makes it easy for us. And then where it gets confusing, of course, previous taxable gifts. So any gifts that they made that they, exceeded the $15,000 freebie, we need to tattle on ourselves and add those back. Tentative tax base, that's where things get even more confusing. You're like, what? And then we calculate the tax as if there was no freebie whatsoever. And then we bring it back in and we're like, oh, that's right. We get a credit for previous gift tax paid. We also get a credit for that big 4 million. So we got to do the math again. 4,077,000. Somebody help me. Don't have this one memorized, but this year's applicable estate tax credit is different than next year's is going to be, because the amount keeps moving. It's a moving target. So anyways, because this estate tax formula can be so confusing, I just want to touch on some of the things that I think are for sure going to land on, any kind of a CFP exam if you plan to take it. But certainly some of these are going to land on our exam in a few weeks, which I think the first week of November, we test on this chapter and others. So we know that the gross estate, this top line here, the biggie, includes some pretty obvious things, including everything that you own at the time of your death. We talked about this goofy dower and curtsy interest only really applies to common law states. And then gift tax paid within 3 years of death. We're going to talk more about that one, as well as gifts made within 3 years that fall under these categories. Transfers with a retained life interest, transfers with the reversionary interest, etc. There's also all of these other crazy sections we'll touch on. So property owned at death, this is the stuff that's really obvious. Everything that you own that has your name on it still, including income that's owed to you before you pass, and state income tax refunds. If those are still floating around out there, they've not been paid to you yet, but you technically, that's your money. It's coming to you. That's part of your estate. Also, anything that you were awarded for pain and suffering before you died. This would happen as a course of maybe a lawsuit that was filed, or maybe a claim you presented, a liability claim against the person who's responsible for your death, and you were awarded some by the jury, pain and suffering posthumously. They're like, well, he lived for a while and it must have been painful. Here's some money for it. But the wrongful death claim portion of a settlement is the money that's paid to your loved ones for the loss of you. That's not money that's associated with your estate. That's their money. We're going to skip over dower and curtsy, but I want to spend some time focusing on the 3-year look back. So 3-year look back, it's confusing because students often think that all gifts made within 3 years of death are somehow clawed back into the estate. That is not true. What is true is that if you make a gift within 3 years of your death, for sure, any gift tax that you paid on that gift is going to be clawed back into your estate. Now, there are a handful of gifts that you can make within 3 years of your death that actually will be clawed back in addition to any gift tax that was paid. And those are the gifts that fall into these categories: a transfer with a life estate, a transfer taking effect at death, a revocable transfer, or the big one we talked about, you realize you're the heir of your ways when you accidentally owned a life insurance policy on your own life. And you're like, whoa, I just learned I'm going to have this whole thing be in my estate. I didn't know that. The agent didn't tell me that. So at the bottom of the screen in the notes section, I've added some common questions that you might see on a test. And let me ask you this. Based on what you know so far about the 3-year look back period, what would happen if you give away a $20,000 car to your nephew and you owe no gift tax on the transfer, and then you die the next week? Is any part of that gift going to be in your gross estate? That top line number where we say gross estate equals. Anybody have a guess? Yes or no? Well, any part of that gift being your gross estate. I've got a shaking head in the room, and that shaking head, it's going side to side, is correct. Now, it will show up in one part of this calculation, but it's not in this top line number. And the place it's going to show up, because technically it's a $20,000 car, you got a $15,000 freebie to somebody, that's going to show up. Sorry, this is such a mess. I should really fix this. It's going to show up where? As a taxable gift that was given previously. So add previously taxable gifts. So that $5,000 is the taxable gift. It's going to show up here, right? But it's not going to be in this line, because this top line is your gross estate. What was clawed into your gross estate? And if you didn't owe gift tax on that gift of a car, then you don't have any problem with the gross estate, including that car. What if you give away $1 million and you owe $400,000 on the gift tax, $400,000 of gift tax on that transfer? So again, and then you go and die within 3 years. So in January, you give a gift of $1 million, and when you file your gift tax return at the end of the year, you pay $400,000 because you've already exceeded your limit in gift tax. Say January of 2019. And then in June 2020, you get hit by a bus. And what part of this transaction is going to mess with your gross estate? What of this January 2019 transaction where you gave away $1 million cash, straight up cash to your nephew, you owed $400,000 worth of gift tax on it, and then you go and die the next year, what part of that would be pushed back into your gross estate? Anybody? What dollar amount from that transaction? Because there is a dollar amount that will be pulled back into your gross estate. What is it? You are correct, Milo and Nick. It is 400,000 because it's gift tax paid on gifts made within 3 years of death, and also the gift itself if it falls in one of these categories, right? Good work. So let's talk about those categories. The transfer with a retained interest, we touched on a little bit last week, but I didn't have good examples for you. Really, any kind of transfer that you have where you're retaining an interest, you're trying to give away, or you're trying to be clever and give your kid your house, but you're of course going to live there. And if you do that, and you retain an interest at the time of your death, the full fair market value of the home is going to be in your estate. Transfers taking, and if you try to give that away, if you try to fix that within 3 years of your death, that's not going to work. That's with a 3-year clawback period. What we're anticipating, of course, is that somebody has this, this desire to start fixing all of the heirs in their previous gifts. And they're like, and when I say heirs, ERRORS, you've made a mistake in how you arranged your estate, and you were a control freak, and you're trying to be clever, and you realize, oh my gosh, I'm going to die. I've got some horrible thing that's going to take me down in the next year. I'm going to quick fix all these. No. You don't get to do that. You will have these things clawed back into your estate. Also, transfers that take effect at death. This is a very confusing one to try to understand, I think. It's the example that was given in the book. I changed the names a little bit because I think their names are bad that they used. But this essentially is saying, if you're going to give a gift that requires the beneficiary to survive you in order to get it, like it's not going to bounce to the beneficiary's estate. So in this example, Bill transfers $1 million to a trust, and the income generated from the gift of $1 million is payable to his wife for the rest of her life, with the remainder payable to himself unless he isn't alive when his wife dies, and then it goes to his daughter Kelly. It's a goofy example, and it's not one you're going to run into often, but it's essentially saying that reversionary interest, because it reverts to him, is going to claw that thing back into his estate. And if he tries to fix this within 3 years of death, it's going to be clawed back in. And then revocable transfers, where you retain some right to this thing that you gave away. This happens often with trusts, where you'll give an asset to a trust irrevocably, but you somehow maintain control over where that asset ultimately is going to go, or the income from the asset. That's an incidence of ownership, and therefore it will also be clawed back into your estate. They talk about the fact that there are some exceptions to this rule, and that's that if when you gave that thing away, you actually were paid the full fair market value for it. So you might have, you might maintain some control over a gift, but if it wasn't really a gift, if it was truly a sale, then this does not apply. Or if you need everybody else's okay in order to make a change, then you don't have the same kind of power of ownership if you've got to get everybody else to approve. We spent a tiny bit of time talking about annuities, and I really don't have a sense of your understanding or comfort level with either the concept of an annuity or the product that is an annuity. Because the term annuity can be used generically to speak to a stream of income, but it's also a product that gets sold. And it's a very confusing product because you can buy a deferred annuity that never is, quote unquote, annuitized into a stream of payments. When we refer to annuities in this class, usually what we're talking about is one that has been converted into a stream of payments. And if you were to buy an annuity today, let's see, I think I looked one up. Let's say you had $1 million and you're like, I totally want to, I didn't. Let's see here. Here's my favorite site to get single premium immediate annuity quotes. It's not where I buy one from. Oh wait, Blueprint Income is another one. So if you go to Blueprint Income, they're a relatively new site that gives all sorts of quotes on various insurance products, but including annuities. And we're going to look at immediate annuity quotes. Let's make up some dates here. 1955. And fine, I'll live in Pennsylvania. And we'll say, yes, fine, the income's just for me. Let's give them $1 million and let's see if you're 65 years old for $1 million. What kind of income will I get for the rest of my life? Huh. Not horrible, I guess. $50,847 a year forever, which sounds fine until you realize it's never going to inflate. But that this first result, Securian Financial, this Minnesota Life company, I think we can do better, by the way. There are other places we can go for better quotes, but the income of $4,238.95 a month, or this $50,867 per year, I asked for a quote on this person's life only, not a joint quote. So the moment this person dies, that income ends. You trade the $1 million for a lifetime income. That's an annuity. If you want to inflate the annuity each year to keep pace with inflation, we go from 50,000 or 51,000 a year down to, oh, no way, I'm not going to sign up. Anyways, it'll go down, believe me. It'll also go down if we do a joint annuity where we say, look, I want it over my life and my spouse's life. So now we're insuring 2 lives for this income that's guaranteed until the second of us dies. They're definitely going to pay us less. But that's what we're referring to when we're talking about annuities. And annuities are a really interesting product right now to people because they're terrified about the stock market. And annuities represent guaranteed income with no volatility. It's not very sexy unless you like stability. And then it's super sexy. And you're like, awesome. I totally love annuities. Now, if you die with an annuity in place, if we go back to that quote I just ran, that was a straight life annuity with no survivorship feature. And it is not going to be in my estate. No part of it. Because that's if I had paid extra, or for my $1 million, they're like, look, this is for your life only. And I'm like, oh my gosh, but I'll be so sad if I die. And like within a week of like pulling the trigger on this annuity, then what? And they're like, well, if you want some kind of survivorship feature, we'll give it to you, but we're going to give you less income. And let's say, yeah, I want at least half to go to somebody if I die within the first X number of years. And let's say that the benefit is like $500,000 that goes to somebody, then that's the amount that's in your estate. So, but if you go for no survivorship feature, nobody gets anything after your death, then there is no part of that annuity product that is in your estate as long as it had been converted to income. And then the survivorship feature, let's say that I ended up buying one for my life and my husband's life combined. I die first, and he's going to continue to get that benefit. Well, the present value of the future income streams he's expected to get would be in my estate. So that's annuities in a nutshell. We'll talk more about those in future chapters. I don't feel like we need to go over jointly owned property much. We've done more exercises where you have to figure out how much of each of these assets is included in the gross estate. The contribution rule tripped some people up in the last one, so did community property, but we've done plenty of those, and if you want more practice, let me know. Powers of appointment, a general power of appointment over somebody's assets means they get clawed into your estate and you're taxed on them. Some people use that as a clever maneuver, and they're like, hey, you don't have much of an estate. Why don't I just give you a general power of appointment over my assets? And then when you die, because it looks like you're probably not going to, outlive me, then you'll just, those assets are still mine. I'll get a step up in the base. So that's actually a maneuver people will use to give away a power of appointment. It's not common, but I think it's interesting. Now, this general power of appointment isn't really a general power of appointment. if you have this HEMS provision associated with it, where you really only have the authority to appoint a person's assets if your gift to whoever you're directing them to is subject to this standard, and the standard health, education, maintenance, and support. This will come up all the time in your life as a planner. You'll see this whole concept illustrated over and over inside of trusts. Proceeds from life insurance, the death benefit if the decedent is the owner, is owner, and the insured, then, and beneficiary could be anybody. In this scenario, if you're the owner and the insured and you die, the death benefit is in your estate. I don't really care who the beneficiary is. I don't even need to get that far. Don't even care, because I know, based on the fact that you owned it and you're the insured, whatever the death benefit is in your estate. Now, I do care who the beneficiary is if you weren't the owner. Let's say you're like, maybe
I didn't get that. Could you try again?
Oh, she's so useless. So let's say that it's not the decedent that's the owner. It's a trust for whatever reason. It's dumb to make the trust. I mean, maybe you'd make a life insurance trust the owner. But if the trust is the owner and it's your life being insured, then we do care who the beneficiary is. Because what if you make the estate the beneficiary? Then suddenly it's in your gross estate again. But let's say you're like, oh my gosh, I've really made a mistake with my ownership of life insurance. I've told you this story about me owning a big policy on myself with my son as the beneficiary. And if I'm like, oh, I should fix this, so let me go ahead and make that trust. I will have a trust own it. And instead of having the estate be the beneficiary, I'll leave it as my son Max. But I do this within 3 years of my death. That's one of those clawbacks, recall. If I try to fix this, it's clawed back if I do it within 3 years. The clock starts ticking once I make this little maneuver, right? If I transfer it to a trust and I do that within 3 years of my death, then I haven't accomplished anything. The other thing that has come up that's been confusing is the cash value. How is cash value included in estates? Remember, the cash value only comes up if the insured is still alive, right? So maybe I own life insurance on my husband. And let's say it's cash value life insurance. Lisa dies. Cash value policy is worth $50,000. That cash value, so again, Eric is the insured. Oops. So it's his life that's the subject of this life insurance policy, but I own it. And that cash value is mine, mine, mine. And when I die, that cash value of $50,000 is going to be in my estate. I might have it set up so that it automatically transfers, the ownership transfers to Eric, or maybe it'll have to go according to my will if I haven't come up with a plan in the contract. But most insurance companies, when they spot that issue, when they spot that the owner is not the insured and there's a cash value, they will almost always ask you, who do you want the successor owner to be? Now, I feel like this is a subject that I probably overemphasize, but I see insurance agents make this mistake all the time where I think maybe we're a little bit more well versed and better trained on how not to set up a life insurance policy if you're trying to keep it in place to help pay estate taxes. You've magnified the problem with the estate if the owner is the insured. If you make the human being that you're worried about their estate taxes the owner of that policy, you've not accomplished much. I guess it's better than not having any life insurance in force, but you've just essentially made 40% of it the subject of estate taxes if they're already over the limit. The other property, which this is getting ahead of ourselves because this is really the subject of the trust chapter. And essentially what it's saying is you can, oops, better color. You can, let's say you're in a family where you've got parents who were married previously, your current spouse, you've got these kids from a former marriage who you're just like, oh my goodness, my second spouse, love to death, but if I die first, I want to make sure that second spouse is taken care of for their life. But as soon as that second spouse is gone, I want that pile of money to go to my kids. So you might, upon your death, if you're the spouse that's about to die, you might say, look, what I'm going to do is fill this Q-tip trust with assets for my second spouse. And let's say it's going to hold, I don't know, $1 million worth of rental property. And the income from those rental properties goes to my second spouse. But then upon my second spouse's death, those assets, including the $1 million and the income from the $1 million worth of real estate and the future income, goes to my kids. This is saying when that second spouse dies, that's when that $1 million worth of property is going to show up in a gross estate. Because upon the first death, you get the marital deduction. So this first person to die gets to take the unlimited marital deduction on the $1 million. So it'll show up in the gross estate, but then you're going to back it out under the unlimited marital deduction. When the second spouse dies, then the assets are absolutely going to show up. That second spouse will have those Q-tip assets be in their estate. Isn't that fun? Doesn't it just make you want to go practice estate planning law? Anyhow, we talked a bit about the valuation of assets being fairly straightforward in that it's the fair market value at the date that you die, or 6 months later. It's an all or nothing proposition, mostly. And the reason for this is what if your estate was made up of really volatile assets that, maybe on the date that you died, the market was raging and your estate was worth 10 million. But then 6 months later, there was a huge market crash. And now that $10 million worth of estate assets is only worth 3 million. If we were jerks, we'd be like, too bad, so sad. You're going to have to pay taxes on the 10 million. And they're like, no, this is not acceptable. So we've got an option for you. And that's that if you want, you can use the alternate valuation date to determine the value of your estate. But you can only use this alternative valuation date if it results in a lower estate number. Some people are like, wait, I want to use the alternate valuation date because it's a higher number. You're like, what? Why would you want that? Could anybody come up with why somebody might want the estate value to be higher? What benefit would the heirs enjoy if the alternate valuation date they used resulted in a higher market value? They really want that step up, right? Your heirs love a step up. And if it takes a while to, settle your estate, they're like crossing their fingers that, um, you know, the alternate valuation date will pan out for them because it's an all or none. The alternate valuation date for some assets might end up being higher at the 6 month mark. But if the total value of your assets using the alternate valuation date is lower, then you get to use it. So um, that's where it comes up occasionally where people are hoping that the market will continue to grow. So you occasionally have assets that don't trade on a, public exchange like real estate or closely held businesses. And those assets uh, end up needing an appraisal. And a closely held business, and we're just talking about a small business that's not publicly traded, sometimes you can get a valuation discount or use valuation discounts as part of the gross estate value based on whether or not there might be, a minority interest, meaning, the share that you owned at the time of your death was so small that you couldn't have controlled anything. You couldn't have called the shots. Therefore, you're like, even though the business is, worth, let's say 10 million and you owned 1/10 of it upon your death, or you owned 1 million, you're like, but my 10% share, I didn't have any controlling interest. So really, who's going to want that? It's really not worth 10% of 10 million. It's maybe discounted down to 500,000 instead. So that would be a minority discount. Another discount would be, look, it's not a publicly traded company. It's hard to, it's a weird asset to try to sell. It's not marketable. And so you could argue that a discount in the valuation would be appropriate there. Or if you've got a key person in the business, it could be, you could argue that that the business value being tied to one person should generate a discount as well. There's a whole section on how we deal with valuing publicly traded stock, because as you know, stock prices change like every time you blink, right? If you log on to, with any of your apps that tell you what's happening in the market and you stare at the ticker symbol for your favorite stock, you see it change constantly. But when it comes to publicly traded stock, you are going to end up using the average of the high and low on the date of death. Of course, you might die on a non-market day, and then there's a whole other formula that we use for that. Or you use the alternate valuation date. So again, the high and low on the alternate valuation date, which this is a common test question, 6 months. Not 3 months, not 9 months, not whatever day you like in between the date of death and 6 months. It's the 6 month mark. So it makes it pretty straightforward. There's another issue around publicly traded stock, and that can be a discount if you own so much stock that selling it would impact the market price. I cannot even believe that's a problem, but it is, and we've got a solution for it. So you future billionaires are going to own blocks and blocks of stock. Good news for you. Although who knows, these rules change so frequently. I'm not going to spend a lot of time going over the calculations on, how you arrive at the right market value for stock on the trading day. I just don't think you're going to do this very often. You might run into it in your working life, and you'll have to refresh your memory on this formula. This whole slide on valuation, if this doesn't scare you, nothing will. This this term, interpolated terminal reserve. It's just the cash value. I mean, there's some wizardry that goes into the calculation, but really we're just talking about cash value. So if you own a policy on somebody else at the time of your death and it has cash value to it, that the value of that life insurance policy will essentially be what could be taken out of that policy for cash. Because, life insurance, people borrow from it all the time. They cash it in. They use the money to pay for all sorts of things. So it's sort of like an asset, although I don't like it being sold that way. It can be treated that way. So let's spend a minute talking about this alternate valuation date, because it can be a pretty powerful tool for the executor to use to lower estate taxes. And that's the whole point. Again, it has to, in order to use it, it has to result in the gross estate being lower and less estate tax being due. And if you use the alternate valuation date, you can't pick and choose. Oh, but one asset was worth less on the date that he died, and the other asset was worth, less on the alternate valuation date. No, 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 no. It's all or none. So, I'm gonna. So the one moment. So the alternate valuation date applies to everything, with some exceptions, of course. We can't make it super simple. So wasting assets, which includes patents, royalties, installment notes, these are things whose value automatically decreases over time. So if you own a patent on, I don't know, some drug, right? That, as the patent comes closer to the expiration date, it reduces in value. Same thing more obviously with installment notes. If somebody owed the decedent, $1,000, that's probably too low to make it interesting. Let's say if somebody owed the decedent $100,000 on a 3% loan, of course, every date that passes that they make payments, the present value of that installment note goes down. So we're automatically going to use the date of death for that for wasting assets. Date of death, the DOD. And then any assets that are disposed of between death and the alternate valuation date, we just use the price that you got for them. The most common asset that gets disposed of, have any guesses? What assets do you think? What is the most common asset to sell after somebody dies? Mom or dad's house, right? Exactly, Erica, a house. So you're like, look, it's a lot of work to take care of somebody else's house. And if you're the executor, one of the first things you're eager to do is get that house ready to sell. I mean, first you're, taking care of all the stuff that's inside of it and, maintaining the property, putting it up for sale. You're not going to wait for the alternate valuation date to decide what makes the most sense. You're going to dispose of that asset as fast as you can. And if its fair market value on the date of death was $300,000, but then you sell it, for $200,000, that $200,000 is what's going to be in the gross estate, even if you end up electing, the alternate valuation date. It doesn't matter. That house was sold, and whatever it's sold for is the price that's going to be used for the final gross estate number. There's some good examples in the book on this, and this is and I got to look to see if it's in this. Was this a question on the homework for this past week? Because this is a common question for us to ask on an exam. I'm going to give you a list of assets, and it's going to include, of course, some wasting assets, It's going to include an asset that gets sold before the alternate valuation date. And then it's going to include some stock that had, a price of X per share on the date of death and Y per share on the alternate valuation date. And I'm going to ask you to calculate what the value of the estate would be if we use the value on the date of death versus the alternate valuation date. Deductions from the gross estate. This is blessedly easy, right? Totally obvious. Funeral expenses, you get to deduct, last medical expenses, administration, all these evaluations that you have to do for the assets. Just think of all of the expenses that you would incur in trying to administer an estate, all deductible. Outstanding debts that the decedent ended up paying for mortgages, income tax due, gift tax due, all this stuff. Obviously, any final bills, like their final gas bill, their final phone bill, etc. Usually, that's going to be small potatoes in the big scheme of things, but it is a deduction. Losses during the administration of the estate, mostly I think about theft. If something gets stolen and there's no insurance for it, that can be a deduction. And then we arrive at the estate tax formula, which again, this whole point of the vast majority of what we've covered in this chapter is talking about what goes into the gross estate, and then from the adjusted gross estate, after we've taken the deductions for everything we just talked about, the easy peasy stuff, the debts, the funeral expenses, the admin stuff, then we get to this adjusted gross estate, where we then subtract marital deduction, so any assets that transferred to the spouse. Charitable deduction. Oh, I'd also like to leave $100,000 to the United Way. Great, we'll reduce your estate by that if that was part of what was in your will. Or if you had an asset that ended up being transferred to a charity through a beneficiary designation. Or if you have a death tax in your state, you get to reduce it for that. That gets us to the taxable estate. And that's when we add back any gifts that you've made. I can't wait till we're all alive long enough that we don't care about this date, 1976. How old would you be today? I guess technically there's probably still quite a few people alive today that may have made significant gifts before 1976, but whatever. The laws changed, and the laws are what really drags you into the minutia here, right? So any gifts made, any taxable gifts made after 1976, we add back, because now we got to do the tax math all over again, because it turns out you lived, right? You made the gift and you continue to live. Awesome. Just know that we're going to drag those taxable gifts forward with you every year that you're alive. And we're going to keep doing the math on them every damn year, because every year the tax schedule changes. And if you were lucky, maybe you made a taxable gift back in the day and you didn't realize that by the time you died, it wasn't going to be taxable because they gave away this huge credit. So we get to this tentative tax base that we now are going to calculate tentatively how much tax you owe. We're not even to the credit yet. We're still talking about, all right, how much was in your estate after all of those, all of those transactions we just went through from your gross estate and subtracted all of those things. Now we come back to this tentative tax base and we do the tax math, which you'll eventually, maybe you already have it memorized, that the first $1 million of taxable estate from the tentative tax base results in a tax of $345,800. Because imagine that's all you had. Maybe your whole taxable estate is $1 million. And you didn't have this handy column here that told you what these numbers were. You're just like, they weren't very thoughtful. They didn't give you all of that. Well, then you'd pull out your spreadsheet and you would do the math, and you would know that the first is just like doing income tax math. The first $10,000 is taxed at 18%. The next layer of 10,000 is taxed at 20. So now we're up to your first $20,000 of estate. Between 20 and 40,000, so the next $20,000 is taxed at 22. The next layer at 24, the next layer at 26, et cetera, et cetera, et cetera. And if you did all of that math on the first million, if you still had any blood sugar left, you would be like, okay, let's add all of that up. And what does it come to? $345,800. Exhausting. Oh, but wait, it gets easier after that, because after the first million, it is simply 40% of everything over. So that becomes your tentative tax. But then we have these credits. You're like, what? I get a credit? This is fantastic. Yes, you get a credit. And this year, that credit is $4,577,800, which essentially is the tax that you would have owed on an estate worth $11,580,000, which is the current lifetime exemption amount. Next year, that lifetime exemption is going to be higher. Who knows? Depending upon the election, it might be struck down. But with what we're working with now, we're expecting it to go up, and that means your applicable estate tax credit will go up. You also get some credit for prior transfers. So what we're referring to here is, let's say you had just inherited, like in your estate was $1 million worth of something you just received from your parents. And they had paid estate taxes on that transfer of $1 million to you. This is just saying, look, we're not monsters. We're not going to tax you again on that thing. We just got our money out of that asset, whatever it was. So no worries. We'll give you credit for that. And then foreign death tax credits. So if you ended up paying taxes in another country on assets, we'll give you a little bit of a break for that. And then we get to the tax liability. And if your executor doesn't pay it, they might become responsible for it. So you might want to shy away from becoming the executor or personal representative on a big estate that might have estate tax due. The estate tax is owed by the estate, not by the heirs. But if somehow, some way, the right amounts don't get paid, then the executor is obviously liable, but also the assets that get distributed, they might get clawed back if the estate tax doesn't get paid. You have to file your estate tax return within 9 months of the decedent's death. You can file extensions, but you don't get too many of those. There's some penalties for failing to file and for failing to pay. And there's a handy example. The adjusted taxable basis to heirs. I know you know these things, but it's a good time to review them. That when you inherit most assets, if you're the lucky recipient of, a big pile of stock, maybe the decedent hardly paid anything for it. And if they would have sold it during their lifetime, would have had a huge taxable gain. But if they just keep holding on to it until death, they know that you, their ultimate heir, is going to enjoy a step up to the fair market value. So that if you were to sell that asset the minute after you received it, you'd essentially have no gain to recognize. You would get the money and not have to pay any capital gains tax. Now, there are some exceptions to that. Gifts that revert back to the original owner that were transferred 1 year before death. So this is you trying to be clever, and you're like, look, I'm about to die. Actually, let's go back to this. Let's say I own, it's my stock. And maybe my cost basis is, 10,000 cost basis, and its fair market value is $1 million or some crazy number. And I think, well, my dad's old. Why don't I just give that stock to my dad, right? And as long as he promises to put it in his will that I get that stock back, because I'm essentially going to use his pending death to get myself a step up. Well, it'll work as long as he lives more than 1 year. But if he doesn't, then that's no, 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 no. I got to take my old basis back. Does that make sense? Yeah. Also, the adjusted taxable basis is a little wonky on joint tenants with rights of survivorship assets. We've done that math before. Community property, they get the double step up. Income with respect to a decedent assets. Those are all the assets that, there was some kind of a tax break when the original money went in. So like for IRAs, a traditional IRA or a traditional 401k, I mean, you're not going to turn your nose up at inheriting something like this, but if you receive one, if you get a traditional IRA from grandma, you're like, oh, it was so nice of her to leave me with an IRA. And you go to cash the whole thing in, you will pay income tax on the entire amount. Income tax will be due. And oh, by the way, the IRS is going to force you to take withdrawals from that. If you're like trying to be all frugal and save it until you're old. No, if you inherit it from a non-spouse, the IRS is like, thank you for taking the withdrawal. We are super eager to tax that money. So please start taking it out now. There's all sorts of rules about inherited IRAs. You'll learn they are tricky. IRAs and 401ks, 403bs, deferred compensation plans. These are all of those wacky arrangements that employers offer to employees as a way to save on their contributions. And so that present tax deduction that you get, the income tax deduction you get when it goes in, is all well and good. But when it's left in your estate, those assets don't get a step up. The IRS and us, we are the IRS, right? We all want you to pay some damn taxes on that. So somebody will pay. And if it's not you, it will be your heirs that will pay income taxes on those dollars. So those assets are called income in respect to the decedent. I don't know why they came up with that term, because there's probably a better term out there we could use. One benefit, the holding period. Let's say that you had died with stock that you had owned for only 6 months before you died. Now, normally, stock that you own for less than a year, any gains that you recognize through the sale of that stock is taxed at regular income tax rates. That's considered a short term holding. And short-term holdings get income tax treatment. Long-term holdings get capital gains tax treatment. But if you die with this asset, automatically it converts to a long-term asset, because the IRS, again, not monsters. They're like, maybe you had no interest in owning all those shares of Exact Science stock and you want to get rid of it. They'll give you long-term capital gains tax treatment.